My name is Varan Karunanantham from iConnect Mortgages. I have Mike Libbey joining us from Your Bottom Line Accounting, and thank you for being here, Mike.
Thank you for having me. Much appreciated.
So we are here to chat about a few things that related to taxes, accounting, home financing. Question number, and there's a myth about it, and we're just here to talk about and say, you know what, I want the audience to hear from a professional rather than hearing from me. The first thing I want to chat with you, Mike, is it make sense? I have clients who want to buy investment properties. The first thing they ask me is, does it make I want to buy it on the holding company. What is your professional opinion on it? I know the answer, but I want to hear that from you.
Absolutely. And so one of the most common things you're going to hear from any accountant in any circumstance or any question that you're generically asking them is, it depends, right? And so that is always going to be the answer for a lot of situations, and that's really where accountants hang their hats. But ultimately, if you're talking about residential properties, 9 out of 10 cases, you're really not going to want to buy a residential property inside of a corporation. Whether it's a holdco, whether it's an opco, whatever that might be, you're not going to want to buy it in there. And so there are a few reasons that I could certainly dig into. Ultimately, one of the main ones is it's passive income. So a lot of people will hear from a friend, a brother, a sister, whomever that might be, that, hey, I'm saving money by way of having a corporation instead of a sole proprietorship or whatever that might be. And so that income is considered to be active income. But when you've got a rental property, and when that gets put inside of a corporation, what ends up happening is that is taxed as passive income. Mm-hmm. And so that's taxed at the highest corporate tax rate.
What is it, 55%?
Exactly.
Yeah.
So it's over 50%, which is certainly more than regardless of whatever tax rate you're going to be at personally. Even if you're over $250,000, it's pretty well guaranteed to be the highest tax rate you're going to pay. On top of that, of course, it will provide you a little bit of liability coverage, but ultimately your accounting fees and legal fees are potentially going to go up tenfold with really no benefit. So liability can be a reason you might want to do that, but it is extremely rare. If you're talking about a commercial property, 9 times out of 10, you will want to put that inside of a corporation, and that's less about the profitability. That is more about the liability. Right. And so one of the things that we say from a residential property perspective is if you're going to buy that inside of a corporation, first and foremost, probably don't. But if it makes sense, we consider it to be the empire approach. If you're thinking of buying, let's say, 10 properties or more and amassing an empire, it is inevitably going to be more about the liability coverage to have all of those doors and all of those properties inside of the corporation. So that's one of the ways it would make sense. But for the overwhelming majority of people, it won't make sense. They've been misinformed where they're of the belief that they're going to save taxes.
And also, if you keep the funds, okay, let's say you have a sale of the real estate residential property, and if the funds goes into the holdco, and you're going to pay the personal taxes when you take it out, right?
Absolutely.
So you're double dipping on the taxes, or you're paying it twice. Right?
Exactly.
You're paying taxes on a corporate way, and also you're paying the personal taxes when you withdraw it. So is it correct to say you're actually losing more on taxes rather than saving on taxes?
Well, and strangely, when you buy a residential property inside of a corporation, one of the things you may want to do is actually intentionally strip all the profits out. Because remember I said that when you have a property inside of a corporation, it's taxed at the highest corporate tax rate as passive income. So you almost want to take out management fees or dividends or payroll or something to be able to intentionally strip the profits. Because if the profits are gone, you're not actually being taxed at a higher corporate tax rate because there are no profits. But then the question becomes, well, why do I have the corporation anyways? Is it really because of the liability coverage? Does it make sense? Do I need the liability coverage? And we've even discussed with many other accounting professionals, and the reality is as long as you've got proper and adequate insurance, there's really no concerns from that perspective.
And if you are already working individual, or if you have business for self, if you're taking a dividend or a management fee, you are increasing your personal taxes as well, right?
Absolutely.
Yeah.
Yep.
So you end up paying more on the personal side,
Exactly.
even if you try to save on the corporate side.
Exactly. Absolutely.
Perfect. So this is another interesting question I always get from a lot of self-employed clients. It's hard to get a financing for self-employed clients. If you are a self-employed, when you go to the major banks, major 5, they ask for your T1s and NOAs. And you and I know a lot of self-employed, they try to do a tax shelter, they try to keep the funds into the holdco, or they don't do a lot of dividend takeout, they just try to save the money in the holdco. What that essentially means is they're going to have a less income for them.
Yep.
And that's become a very challenging, go and get the financing.
Yep.
I just want to ask your professional experience, does it make sense to keep a less income and go to alternate lenders to borrow at a higher interest rate versus paying a higher high income tax or high income on the taxes and save on the interest rate?
So that's actually that's a really good question, and ultimately we've run these scenarios for a lot of our clients, and we actually have a lot of mortgage brokers that we work with that will run this scenario as well. Because what really ends up happening is this is the example. This is a scenario you're going to need to run with. Let's just say that I'm paying myself from my corporation $100,000 salary, and a mortgage broker says that in order to qualify for X property that I'm looking to purchase, whether it's $1 million investment property or whatever that might be, they're saying you need to show $200,000 of salary.
Okay.
And if that's the case, you're going to, whether you need it or not, pay yourself an extra $100,000.
And the taxes on that is almost 50,000.
And there's taxes on that, absolutely. So what's ending up happening here is, in order to qualify for a mortgage with, let's say, an A lender or one of the big five, you're unintentionally paying yourself considerably more and increasing your personal tax liability, arguably unnecessarily. And so let's say you're going to pay an extra $30,000, $40,000 in taxes on that. Yeah. What you've just done is you've paid the government an extra $40,000 in taxes, but the important question is that more beneficial than the interest discrepancy between a lender and a B lender? And so it really depends. You should certainly ask a mortgage broker their professional opinion with that, but ultimately what ends up happening is, okay, if I go with a B lender, sure, I'm paying more interest, but is it $40,000 more interest over that period, right? And so you have to compare the apples to apples when you're looking at interest to interest to be able to determine, is this really more beneficial to pay me more in the way that my mortgage broker says that I kind of have to?
This is applicable to real estate agents and any other self-employed clients as well, right?
Yep, absolutely.
It could be doctors, or it could be anyone.
Yep.
So my next question is, especially, it doesn't make any sense if you're buying an investment property because you're going to write off the taxes, you're going to write off the interest on your personal taxes anyways.
Yep.
So I think, in my opinion, I will say, do your judgment.
Yep.
But I think you know the answer.
Absolutely. Absolutely. No, for sure. And I mean, it really does come down to the interest. Is it worth paying yourself considerably more from your corporation where you're able to shelter that at about 12.5% corporately?
Yeah.
And pay 30, 40, 53% on whatever you're going to be taking out versus a B lender. And I know a lot of B lenders have bad stigma to it for whatever reason. To some people, they could be fantastic tools for a lot of people.
A lot of people to navigate through your financing needs.
Yep.
So Mike, this is a very interesting topic right now. So interest rate has gone up. That's mean not most of the investors on a residential side, they are not cash flow positive. They're actually sinking in negative cash flow. And how it can be tax beneficial having a high income, high interest rate in overall your tax planning? Like, is it worth it to, like, because you can write off pretty much all the expenses that you're paying on the interest.
For sure.
But you're not making any cash flow on the investment properties because the interest rate has gone up and rents are almost stagnant. It's not moving up. How could you kind of use a high interest rate to be more efficient on taxes on investment properties?
So, I mean, ultimately, high interest rates, well, yes, they will theoretically increase your deduction, which is technically a good thing for tax purposes. From a net basis, maybe not so much. Yep. But ultimately, first and foremost, your goal should certainly be, as best you can, to find a rental property or investment property that is cash flow positive. We know a lot of people were obviously caught off guard with the high interest rates for the last couple of years, and that ultimately did hit a lot of people pretty hard, and so they are paying a lot of money out of pocket. Now, what the majority of people in those circumstances, as well as the majority of circumstances, are in it for is the long-term appreciation. Now, you could argue all day long whether the market's going to go up, whether it's going to go down. Nobody necessarily knows ultimately.
We don't have a crystal ball.
Everybody's crystal ball is very muddy and muddier than ever right now. And so ultimately, that's what most people are looking for, is the appreciation. While, yes, you certainly want to be cash flow positive, I would say one of the quote-unquote benefits would be that now you've got a increased deduction. And so you're going to be paying theoretically considerably less tax liability on that income. So, of course, you've got your rental property, you've got your rental income, you get your heat, hydro, mortgage interest, property taxes, insurance, etc. But your interest rate has skyrocketed. Yep. So technically, your net rental property income is going to go down, which is a good thing for tax purposes. It is important to know the principal is not actually a deduction. Of course, that's going to be cash flow out of your pocket paying that. But the bulk majority right now in today's world is, of course, going to interest, for better or worse. Yeah. And so that is an increased deduction, which is going to in turn help reduce tax liability.
So you think that write-off on the interest will kind of equal the cash flow negative that you have? It depends on the scenario. I know it's really hard to say.
Depends on the scenario, for sure. It's going to help.
But we don't know at what extent.
But you don't know ultimately. And for the majority of people, hopefully, even on your tax return, even if you might be cash flow negative, you might actually be showing that you're making profits on that property on a net basis,
Okay.
which is, again, technically a good thing, but it can be salt in the wound for a lot of people because I've just paid that much money out of pocket from a cash flow perspective, and now I've got to pay CRA extra money for this net rental income, even though I don't actually have the cash. And that is because of the principal that you're paying down from a mortgage perspective. So it is difficult for some people to swallow.
Yeah.
But
it's a case by case.
Exactly. Very much case by case for sure.
So Mike, we are almost getting into tax season, I think April 30th. So what are the key benefits, or what are any significant changes in terms of how you can save on your taxes for 2024?
Absolutely.
Or 2023, the last year.
Absolutely, yeah. So there have been a lot of changes that have kind of come to fruition this year that will impact a lot of people. There's two major ones that are going to be impacting people. That's the new Bare Trust laws, where a lot of people who have co-signed on properties or they're on their parents' bank accounts and things like that will all of a sudden now need to file what's called a Bare Trust return.
Okay.
So that's going to catch a lot of people off guard. And that's
what is called Bare Tax?
It's called a Bare Trust.
Bare
so
Trust.
It's effectively a trust return, a T3 trust return that you're going to be filing. So that's very important. That's going to catch, like
First
I said,
time I'm hearing that,
a
to be
lot
honest.
of people off guard. And so, like I mentioned before, we've got our new smart tax app called YBL Connect, where we really have a conditional questionnaire that's going out to all of our clients that's going to explain the nuances of that and determine if anybody has to do that, because a lot of people are really just not aware. And so another big one, this isn't necessarily good news for most people, especially people who are used to flipping properties. There are new anti-flipping property rules. That has also caught a lot of people off guard, wherein if you're effectively flipping a property within 365 days, you no longer get to have the capital gains tax, which effectively reduces the amount of tax you're going to pay by roughly 50%. That's no longer.
So
there
this
are
become a
exclusions.
business income now, right?
Exactly. Yeah. There are exclusions to that, but for the majority of people, they are going to pay full tax dollars on
100%.
that. 100%. Yep.
So if you are selling a property and if you're having a $200,000 gain,
Yep.
prior to this you pay on 100,000, or you're going to pay on 200,000.
Well, whatever tax rate that brings you up to. If my gain is $200,000, under prior circumstances, you get to reduce that capital gain into 50% of that, which is $100,000, and then pay taxes on that at whatever rate that brings you to. Now you're paying it on the $200,000.
So you have to be mindful if you sold a property within the last 12 months.
Extremely mindful. Or moving forward, right? It's changed a lot of people's business models as well, because holy smokes. I was used to flipping properties or doing this and doing that, and now all of a sudden they're going to be paying literally double the amount of tax than they would have, if not more. So that's going to hit people kind of unexpectedly. I mean, some of the generic things you can obviously do to reduce your taxes are track your expenses. It seems very, very fundamental and rudimentary, but it really is extremely important. And so whether you're a sole proprietorship, partnership, or incorporated, please just make sure you're doing that on a regular basis. And ultimately, the main reason for that is because what ends up happening for a lot of people is they're not keeping track. They're not aware. And so at the end of the year, they're missing considerable deductions and leaving considerable dollars on the table. And so by way of just making sure you're tracking that on a regular basis, whether you're doing it yourself, hiring a bookkeeper, an accountant, whoever that might be, you're going to save taxes.
So those expenses still can be written off.
Absolutely. Absolutely. And so, I mean, of course, you want to track your expenses. You want to make sure you're utilizing all of the opportunities available, whether that's writing off your car, writing off a portion of your house, writing off internet, cell phones, supplies, client gifts, legitimate travel expenses, opportunities with income splitting with your family members, to be able to make sure that, of course, that is legitimate. And you've got the paper trail as well. Very important to have that. But ultimately, there are a couple other opportunities as well. So, I mean, most people know about RSPs, but RSPs can be fantastic tools that, of course, can save you considerable tax dollars, or at least defer those tax dollars to a later point. I'm not a financial advisor, and so certainly double check that.
Since you brought it up, can you mention, can you talk about the new home buyers account, FSA?
That is exactly what I was going to mention next. Yeah, so it's the first home savings account.
First home savings account, FSA, right?
Absolutely. And so that is actually a fantastic tool as well. Actually, it's extremely, extremely impactful. And so what it is it's actually very similar to an RRSP, wherein when you contribute to that, let's use some easy math. Let's assume that I've contributed $1,000 to my first home savings account. Let's assume that I'm at a 30% tax bracket, personally. if I contribute $1,000 to my FHSA,
Yeah.
I'm going to save roughly $300 on my personal tax
So that's
return.
almost 30%.
It's almost 30%.
Yeah.
It's directly related to whatever tax bracket you're at. Now, very, very, very important distinction between that and an RSP. When you withdraw from your RSP, you're going to be taxed on that. When you utilize your FHSA and have that pay for your first house, you're not taxed on that. So you get the deduction by way of contributing, but you're not taxed on the withdrawal, which is an extremely important distinction. And it's actually not necessarily just for first home buyers, but if you haven't owned a house in the last 4 years, you can
So
also
that's not a
qualify
bad
for that
time
as
frame.
well.
4
That's
years.
not bad at all. Absolutely. So it's pretty lucrative. It's a pretty good opportunity.
Anything else you want to mention, Mike?
No, I mean, this has been fantastic. I appreciate your time.
Thank you for being here on a Friday night. Why don't you tell the audience how they can contact you to learn more or to get your services done?
Absolutely. Thank you for having me. Much appreciated. And so, I mean, you can find us on all social media, whether it's Instagram, LinkedIn, Facebook, Twitter. By all means, check us out, www.yourbottomline.ca. We've got some fantastic tools and opportunities there for people, resources, checklists, templates, especially for those trying to qualify or to track their income and expenses for investment properties. And we actually just released our 2023 tax checklist with all the new changes, all the updates that'll help people out.
Perfect.
Thanks for having me.
And you guys know where you can find me, DM me or call me if you have any questions.